Traders Corner is proudly brought to you by IG, the specialists in CFD trading.
Welcome back. You're watching Traders Corner. Joining me is Garth McKenzie. He's founder and owner of Traders Corner. Welcome, Garth. Thanks very much for coming in. Garth, today we're looking at the concept of the 3-day rule in trading and how to apply it to shock news. So perhaps let's start off. What is the 3-day rule?
Yeah, basically what the 3-day rule is something that I've observed over the years of trading. And I've noticed that whenever there's shock news that comes into the market or relating to some specific stock, very often it takes the market 3 days to fully digest that news. And often you do find that markets overreact to news. And then there tends to be a bit of a snap back in the other direction after that overreaction is completed. You can think of it a little bit like pulling an elastic band back and then letting it go. And that's kind of the type of reaction that we're looking at here. And I've got a couple of examples to show how it works. But before we get into the examples, there's always this saying in the market, don't catch falling knives or don't catch falling pianos, which is right. That's a good philosophy. However, in situations, specific situations, you can try to look at ways to try and capture an overreaction in a stock.
So a trading opportunity.
It's really just a short-term trading opportunity. That's all we're looking for. A very, very short-term trading opportunity of maybe a couple of days to maybe a week or two at the very most. And those are the examples that we're going to look at today. And we've also got a trade that I've done this week in Steinhof, which conformed to this 3-day rule very nicely.
Okay, so looking at some of those previous examples, and I think the first one you wanted to highlight is First Strand. So First Strand, surprise interest rate hike, that was back in January, 50 basis points. In fact, I think it took the market totally by surprise because nobody expected that one. Yeah,
absolutely. So if you look at the chart of First Strand that's up on the screen at the moment, you can see it quite clearly illustrated here. You'll notice that back in January, we saw the share price of First Strand taking a rather sharp drop. It had been falling throughout the month of January anyway, but towards the end of January, Jill Marcus came out and she surprised the market with a 50 basis point interest rate increase. And I think on that occasion, 25 out of 25 economists had forecast no interest rate hike, and they all got it wrong clearly. And the share prices of the banks and the interest rate sensitive stocks took a bit of a beating on the back of that news. And it took 3 days for that news to be digested. So if you look at the chart of First Strand here, you can see the share price suddenly falling quite dramatically. It fell for a further 3 days thereafter. And then it found some stability. But what's very interesting, and what you always look for with these sort of situations with a 3-day rule, is you look for a volume spike, like what we've seen over there. And the volume spike indicates that there's a huge amount of selling pressure, obviously, but at the same time there also must be a huge amount of buying pressure. You can't just have sellers without buyers in order to ratchet up that amount of volume. So you get a tremendous volume spike like that. And what you'll find is that volume spike is caused by buyers and sellers whose views and their emotional constitution, if you like, are diametrically opposed. On the sell side, you've got people who are panicking, who are selling out at any price. You can say they're behaving irrationally. And then on the other hand, you've got buyers who see an opportunity, they see a bargain, they're behaving far more rationally in buying up the stock and taking the stock off the hands of these weak-minded sellers, if you like. And what you find is that you've got these two parties that are diametrically opposed in their view, but eventually the selling pressure actually abates. And what's left behind is a vacuum of selling pressure thereafter, and that's when you get the bounce in the share price afterwards. And that's exactly what we saw with First Strand here. So you saw a huge amount of volume trade over a 3-day period. We got that volume spike. Then the 3rd day comes along and you get the stability that sets in. And after that, very often what we do is we look on the 3rd day, or sometimes it's the 4th day, you look for that stability to set in, and that very often is your buying opportunity to then take advantage of a stock that's been beaten down too far and it's overreacted to the news. And then you very often get a fairly quick bounce. Looking out a week to 2 weeks, you'll often find you can get a 5 to 10% bounce in the share price. In the case of First Strand here, it actually just didn't stop. It carried on bouncing and carried on going higher and higher. And right now we're sitting at all-time highs on this share price. But we've got some other examples as well to also illustrate the point here.
Garth, would you be watching for that volume spike? So yes, you see the bad news, you see the share price falling. would you only jump in once you saw that volume spike and come in afterwards?
Yes, that's the important thing. You need to wait for that volume spike to have happened, because that implies that the sellers have exhausted themselves when you've seen that tremendous amount of volume going through the market. You want to try and buy in after that. This is where the point about not catching falling knives is important, because if you go along on day one or day two after a shock news event like this, chances are you're going to be buying it on the way down whilst there's very, very heavy selling pressure behind it. You want to actually wait for the selling pressure to have stopped, for things to start to settle, and you can look at that. You can look at an intraday graph to try and understand when the selling pressure has actually abated, and then you can start to see some buying pressure come in, and that's how you would do it. So the important thing with a 3-day rule like this is, first of all, wait the 3 days. Second thing is there must be a catalyst of some sort to cause this reaction. And we'll look at other catalysts on the other examples we've got now. And then the third thing is you want to see that volume spike. You ideally want to see all three of those things present when trading around this 3-day rule.
Okay, so next example, and that's Pinnacle.
Yeah, so Pinnacle was also very interesting earlier this year. It made headlines for a number of weeks. And what you can see here, this was at the end of March. The share price literally dropped by half in 2 days. And the reason for that was that there was one of their directors was arrested for allegedly bribing a police official on a tender for 5 million rand. And big news, front page of the newspapers kind of stuff. And the share price dropped by half. And the big question is, realistically, was the company all of a sudden worth half what it was 2 days prior? Probably not. It was a massive big overreaction that we saw in the share price here. And they did see the corresponding bounce thereafter as well. But once again, if you wanted to trade this opportunity, you needed to wait for the 3rd day and look at this 3-day rule to do it. So again, you saw the volume spike. We saw a huge amount of shares going through the stock. And then the 3rd day, we saw some stability setting in. And then the share price bounced. And I mean, in this case, it bounced from 11 Rand to 15 Rand in about 4 days. So that's a really, really great trading opportunity if you manage to time it correctly. And that's the important thing. I mean, this is a trading show and we're talking about a very specific trading strategy here. But it does seem to work. I've traded this successfully on all of these stocks that we're talking about here now. We also highlighted them on traderscorner.co.za when these opportunities have been there. And it's the type of situation I think you could actually build a trading system around these types of events. You'd probably only trade 15 times in a year, maybe, if that. But I'd stick my neck out and say that you'd be right on nearly all of those occasions.
Important to know when to exit that trade, though, Garth.
It is important to know, and my sort of rule with it really is you're generally out within a week. You don't hang on for too long, because as you can see with the Pinnacle here, it bounced, sure, but then the share price basically did nothing for several months thereafter. All you're doing here is you're looking to try and take advantage of that overreaction in the share price and the quick snapback that very often happens after that. And you'll get that snapback invariably within a week, maybe 2 weeks at the most. But you don't want to hang around for too long in these types of situations. Bad news, as in both of these examples here, is not always, you don't want to hang around because of bad news, but
in case there's more bad news.
Yeah, in case there's more bad news. But you do get that oversold situation and the overreaction, which then results in a snapback thereafter.
Okay, the third stock you want to highlight, that's ShopRite. So
yes.
Take us through that one. So
this is a slightly more recent example. This actually happened in late August. And what you can see here, also ShopRite dropped very, very sharply. And the result, or the reason for this, was that the company issued results that missed market's estimates. And we saw the share price getting hit very hard for 3 days in a row. Again, you got this huge big volume spike. And on the 3rd day, we saw some stability settling in, and there was a nice bounce that came thereafter. And here we saw the share price bouncing from 140 Rand back to 150 Rand within a week. And that's a really nice tradable opportunity that you're talking about there. You're looking at a bounce of more than 5%, which is very, very tradable.
Okay, so your trade of the week, that's Steinhof. So let's take a look at Steinhof and use that as an example then.
Yeah, so the share that I've traded this week is Steinhof. This is an opportunity that we identified last week, and we actually published the idea on traderscorner.co.za for our subscribers to act on. And it worked beautifully. Again, this was a perfect 3-day rule stuff. And what we saw was that on the 1st of September, the company came out with a trading update that missed market's estimates. and that saw fairly aggressive selling in the 3 days thereafter. You can see that was the 1st of September there, the day after, and then the following day. And it saw the share price really dropping from about 52 Rand, dropped all the way down to 46 Rand within that 3-day period. So that's quite a sharp drop that you see in a quality share like this. And what we identified the 3 days of selling, we saw the volume spike. So you can see all of the criteria came together here for this 3-day rule. If I then look further in and go and have a look at an intraday graph of Steinhof, this is now a 10-minute chart that we're looking at here. You can see the heavy selling all the way from above 50 Rand, down, down, down. Then on the 4th of September here, that was day 3 after the negative news had come out. We saw a large amount of volume trading on the intraday basis there, and then we saw a reversal candle on the 10-minute chart here, and we started to notice some buying interest coming in. So what I did for our portfolio is I went in, I actually bought in at different stages, but I ended up buying in at an average price of 47.30 Rand, having seen that it was the 3rd day, knowing that we had the volume spike, and also knowing that we had an intraday reversal in the stock's price. I went along, bought at 47.30 Rand and put a stop loss out the way at 45.50 Rand. And it worked really well for us, and we actually did end up selling it out the same day, up just shy of 50 Rand, which I'll come back to now. But if we just go through the mechanics of this trade first of all, and have a look at what constituted this trade. So I went along, I bought at 47.30 Rand. The stop loss was 45.50 Rand. The risk per share, therefore, is 1.80 Rand. That's the difference between where we went into the trade and where our stop loss would have chucked us out. The risk that I took was 1.5% of our portfolio value. So we've got 331,000 Rand in our portfolio at the moment. 1.5% of that is 4,965 Rand. That's what I'm effectively willing to lose if the stop loss gets hit in this case. So we divide the portfolio risk, and we divide that by the risk per share, and that gives me a number of 2,758 shares. So I've rounded it down to 2,700 CFDs, and that's what I traded for the portfolio on this trade. The target that I was looking for was 50 Rand, and as I say, all I'm looking for in a situation like this is a quick oversold bounce of between 5 and 10%.
Yeah.
Happy to take that, no more. Therefore the risk to reward ratio on this trade was 1 to 1.5. Not a fantastic risk to reward ratio, but I also know that the probability of success with these types of trades is very high, given all of the examples that I've cited previously and the number of examples I've seen in the past from trading this. And then just as a note, the exposure that we took on this trade was 127,000 Rand. So that's the total value of the shares that we effectively bought for this. And it worked out very, very nicely for us. As you can see, I mentioned that I sold it out the same day, basically later that afternoon. I sold out the stock at 49.80 Rand, just shy of the 50 Rand level that I wanted to get out. It has been sticky around the 50 Rand level over recent days, which you would expect. It's a round number, and there's also a fair amount of technical resistance at that area as well. So getting out quickly was the right thing to do, and that banked us a profit of 6,237 Rand on this trade, which is not bad considering we made it on one day. We didn't even have to hold this position overnight.
Okay, so how does your portfolio look as it stands now then?
All right, at the moment it's looking good. We are up from last week's trade. The only 2 positions that we've got to speak of this week are our option structure, which I discussed on last week's show. We're still running that out until the futures close out, which is next week, Thursday. And then there's the Steinhof trade, which we did during the week. I'm in and out of it already. Bought at 47.30 Rand, sold at 49.80 Rand, and that banked us a profit of 6,200 Rand. So our portfolio value is sitting at 337,000 Rand. That's up 35% for the year to date. We don't have any other positions of any significance open right now, other than that option structure, which will run out until next week futures close out.
Okay, almost out of time. Details of upcoming courses?
Yes, so I've got 3 courses still coming up this month in Cape Town this weekend, the 13th of September, and then Durban after that, and Johannesburg on the 27th of September. I'm running this as part of the Traders Corner 5-year birthday promotion, so you save 1,000 Rand on this course. If you'd like to attend, please email me, garth@traderscorner.co.za, and I'll send you the details.
Garth, we have to leave it there. A pleasure as always. Thank you very much.
Thanks.
That's Garth McKenzie. He's founder and owner of Traders Corner.
Traders Corner is proudly brought to you by IG, the specialists in CFD trading.